This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
Good morning, guys, and welcome to International Real Estate Economics class. Good to see you all here, and also I would like to welcome those who are not here because of travel ban, but would be listening to this lecture capture later today. Just to make you all aware that university has a very comprehensive plan to support all those who are affected. And there is information on the university website as well as on this sheet. There are some number and website. If you have any concern, please get in touch with the university. What I'm going to do today is to, first of all, we have Jeremy here. Are you going to speak about? As you wish. That's fair enough. So what my purpose today is to give you an introduction of a subject which is called International Real Estate Economics. Let me ask you, how many of you have joined the Master Property Program this semester? Right, all of you, for many of you, this is second year or second semester, so that's good. Because in this subject, we use a lot of terminology related to real estate. Having said that, there is a glossary which has been posted on LMS. So make sure if you are not familiar with any terminology, either you ask here or try and refer to those dictionary which is there already on LMS. There are two important words here in the title of this subject. One is international, and then the second thing is markets. Now, these two important words have very interesting meaning for real estate. Real estate, as we all know, we think that it's largely used by local, right? It has a local relevance, local usefulness. Then why are we using the word international? The reason for that is very simple, because if you look at the activity that is happening in real estate market, a lot is happening in the international market, in the sense that there is a lot of capital flows across different geographies. There are also property developers who are operating in different markets. So it's becoming much more important for us to understand how real estate is becoming internationalized. There's not a global market yet, in the sense that it's not a product, it's not an asset class which is similar across the whole globe. There are differences there in the way the property is used, in the way the property is invested in the way property is developed. But it's becoming international, increasingly convergent. The second word that we use here is the markets. Now, there are different sub-markets that operate within the real estate. They are classified as the use market, which is for the use of property. Here, there is a landlord, there's a tenant. Landlord supplies space, and tenants, they use space, they demand space. So there is a market for use of property. Then there is a market for investment in property, where investors operate, in the sense that there are investors who want to buy properties, there are investors who want to sell properties. Sometimes developers also act as investors. Now, interesting feature of the investment market is that these investors are not looking at property as an exclusive asset to invest in. They invest in different types of asset classes. They invest in stocks, bonds, currency market, and many others besides property. For them, their objective is to maximize risk-adjusted return. And whichever asset class, be it property, be it share market, be it bonds, gives them highest risk-adjusted return, that's the asset where they will invest in. So here property competes with all other asset classes. So the asset market operates in slightly interesting way, and that's one of the most important element here. The third is the development sector, where the developers, they supply new space, they build new space, and whenever there's a shortage in the used market, whenever there's a demand in the investment market, there are those developers who supply new space. So these different markets operate very differently. There are cycles which are very different. The rental cycle is very different than the investment cycle or the development cycle. There are overlaps, but their duration and amplitude could vary. So what we are going to do in this subject is to address the international aspect of real estate by these different sub-markets. Now, international poses another challenge. How are we going to deal with international? Are we going to deal with country by country? Are we going to deal it with regions? Are we going to say that, okay, let's look at used market, and the similar type of used market should be classified as one? How do we classify these different markets in order to understand what is happening in international domain? So some of these questions will come up as we go along. So what I intend to do is to very briefly introduce the teaching team. Some of you I have taught before. You were in property markets and valuation class last year. And some of you I'm meeting for the first time, so it's a good idea for us to touch base. And then I will give you a brief introduction to the subject. What are the objectives of this subject? Subject guide and some organizational remarks. After doing this, then we'll move into introducing the subject a little bit more by looking at some of the concepts that we'll play with. As an introduction, I'm professor in property here at the University of Melbourne. I came in here in 2011, so it's almost like 9 years that I've been here. Before that, I've worked both in industry as well as in academics. I used to work for a mortgage financing company and then later into an infrastructure finance company. Also in academics in Japan and the UK before having come here. My research area relates to housing and mortgages and international property. Besides that, I've also done work along a number of areas like land economics and brownfield risk and understanding of brownfield risk. Let's get into the course objective. So what is this course going to deal with? The first objective that we have for ourselves is to understand the international activity in commercial property market. The focus is commercial property market. So we'll try and understand the international activity. What do we mean by activity? By that we mean how in the used market demand and supply for space is working across different markets. Why rentals in some markets are higher than the others. Why some market is growing much faster in terms of rentals compared to others. Which is the market which is at peak while the other is low, and why it is so. In the investment market, where are the capital flows coming from? Who is investing? And some of the data we'll look at later today. Which are the markets which are receiving huge chunk of capital inflows? And where is this capital inflow coming from? What is the motivation of investors to invest in international market? You would agree with me that when we talk about international, for an investor who is based in a country, knowing information about a market in another country is difficult, right? So if say you are sitting here in Australia and you want to invest in, let's say, Singapore, the knowledge that you have about Australian market is far greater than what you would have in Singaporean market. You would compete with the players there. And property being a unique asset class, it's very important for you to understand that market before you put your money in. With all these challenges, if you're going to invest in that market, there has to be a reason, right? We'll explore that. We'll provide a theoretical framework. Any discussion, while the activity and the data around activity gives us what is happening in the market, but a systematic understanding of a market requires us to have a theoretical framework through which we can analyze. So let's try and look at some of those theoretical framework and see which theory can explain what is happening in the market. And that becomes an important dimension of this subject. Then we'll look at the similarity and differences that are there in different property markets across different countries. Different countries have different institutions, political, economic, and property market specific. Property markets operate within these institutions. The rules of the game are determined by these institutions, which are very different across different countries. It's very important for us to understand the similarity and differences and the potential for convergence of these institutions over a period of time, and how they impact on the use, investment, and development of property market properties. We'll also talk about real estate profession, real estate service provision, because that's an important area. Property doesn't get transacted on a daily basis, we all know. It's very difficult to determine what the value of a property is. Now, given that there is a heterogeneity in the market, given that there's a paucity in the data, there is real estate service provisioning as a profession that has emerged, whose main job is to provide information. So we'll try and understand the role of real estate service provision in internationalization of property market. Who are these real estate service providers? These are the companies like JLL, CBRE, Cushman. We'll see how they have internationalized and the role which they have played in internationalization of property markets. The final objective of this particular subject is to identify and explain the process of internationalization. What is the process through which property markets are becoming internationalized? Do we see a convergence there? Would we expect that all markets across different countries would behave similarly? If that's the case, then property cycles would also move in a similar way. So if there's a peak in one country, the other country would also have a similar peak. But are we going in that direction? To what extent the markets have converged or on the path to convergence? Why is that important? Is because in investment, one of the motives for investor is to combine assets which don't correlate with each other so as to get diversification benefit. So if one market or one asset is at peak, another asset could be on different part of the cycle. So overall risk-adjusted return could be maximized. However, if, for example, markets have converged, they move in the same direction, this diversification benefits, they go away, right? So the whole story of diversification gets nullified if the markets are convergence. The other importance of internationalization is standardization. Standardization in the kind of space that is being developed, in the vehicles through which investment happens, and so on. At the moment, there are so many different types of vehicles through development, through investment takes place, which differ across countries. So are we seeing standardization there? What is happening to the activity? What is happening to the performance of property markets? What is happening to the rental cycle? What is happening to the property investment cycle? All these become important questions when we try and understand what is the process of internationalization. So what would you learn after this subject? What information or what knowledge would you have after you complete this subject in 12th week, right? Property is a global profession that you would understand. So even if you're based in Australia here, your market is not limited to Australia because there is only that much of asset that is available for investment. You would be looking at investment opportunities elsewhere. So you need to understand that global market. So what you would do, what you would learn throughout the subject is, number one, how the real estate markets operate in an international context. What is the role of government and other institutions in property market? Now this is crucial. You need to understand what is the risk to your investment, and a large part of that risk comes from the institutions within which the property markets operate. How the cultural influences affect choice in real estate. What are the preferences for ownership? Why in some countries you find shorter leases than others? So these are some of those cultural choices which you will need to understand when you are looking at international property markets. The teaching, the way it is organized, is that there are 12 2-hour lecture and there will be 11 one-hour tutorials. So you would have signed up into one of the 3 tutorials that are available. One of them I will be doing, and the remaining 2, Marvin would be teaching you. The assessment is structured as a final exam, which has 50% weight in overall assessment. It's also a hurdle in the sense you have to pass that exam. And there will be an individual assignment, which is 50% in weight. Individual assignment would be very interesting because what you would be doing here is that you would be constructing a portfolio of investment by combining property assets from different countries. We'll talk about this in fairly good detail, and there will be a good amount of support that will be available to you as you go along in your assignment. So there are 3 components of your assignment. One is to analyze property markets in international context and look for opportunities for investment and diversification. We'll talk about theories, we'll do some practical example, and you would implement this one by identifying the markets which gives you the best risk-adjusted return. Now, there will be guidance that will be provided to you, as I said to you earlier. And what this assignment requires is a detailed information gathering and analysis of international market. So you would be reading a lot of professional reports prepared by IPCs like JLL or CBRE or Cushman's, and you would also be playing with data which is provided by MSCI IPD, which is on real estate return across different markets. So these would be 2 important sources for your assignment, and we'll discuss that as we go along. All the lecture slide, tutorial briefing, and assignments would be posted on LMS, which you can download. There are key references to this subject. The first one is a book which I wrote a few years back on international real estate economics. There are copies of this book in library. Has good information, talks about good theories which can explain international property markets and so on. Now, one thing which I would like to say is that this co-op, which is right across the road, is closing down. And I saw that they are offering good discount on their books. And this one probably is at 60% discount or 50% discount if you want to grab a new one. The other one is Real Estate Finance in the New Economy. Here it talks about the risk in real estate finance. Again, there are plenty of copies in our library. We won't be using this book in greater detail, but very selective aspects of some of the chapters we would be referring in our lecture, so you don't need to buy that. I'll try and post those select excerpts from this book in our on the LMS. The second part, which are other reference material, they are quite important. I'll be posting on a need basis on LMS. These are reports from JLL, CBRE, some journal articles, and so on. In addition to that, I would also encourage you to use internet sources, particularly the reports by different agents. This is how the structure of our lecture and tutorial look like. Today is the first lecture, just a brief overview of the subject and some interesting discussion on international property markets. In the next lecture, we'll talk about some of the theories that can be used to explain international property market. So these would be theories from trade as well as theories from finance. Then on 20th, we'll talk about first submarket, which is the occupation real estate. This is the market for use of properties. How that is shaping up in the context of internationalization. On 3rd of April, on 27th of March, we'll look at international real estate service providers to understand why they have internationalized. Like JLL and CBRE, they originated either in the US or UK. Why have they internationalized? What was their motivation to internationalization? And the role that these IPCs have played in internationalization of property markets. On 3rd April, we'll talk about international real estate investment. Now, this is an important topic because a lot of capital flows happen across different countries. In a typical investment portfolio, nearly 15 to 25% of asset allocation is on property, which is quite significant. So we need to understand the role that international or internationalization plays in portfolio diversification. And that then ties up with your assignment, which we'll be discussing in tutorial, how to construct a portfolio with assets from different countries in order to maximize your risk-adjusted return. So that we'll discuss over a few tutorials. On 24th April, we'll start discussing different markets, starting with European property market. Now, Europe is quite diverse. Though we call it, when we talk about Europe, it looks like it's just very similar Europe kind of thing. But there are so much of divergence in institutions and so much different dimensions to the practices within which property markets operate is phenomenal. The Central and Eastern Europe is very different than the UK and France. Even UK and France have very significant differences in their institutions, both political as well as economic, and within which the property markets would have to operate. So it would be an interesting discussion on European property market, which we'll cover in our in two lectures, lecture on 24th and on 1st of May. After that, we'll talk about Asia Pacific real estate market. Again, Asia Pacific as a region is very diverse. Japan, Singapore, China, and other markets in the region, they operate very differently. The institutions are very different. Lecture on 15th of May would be on Chinese property markets. 22nd of May, we'll talk about the third subsector, which is international property development. The development sector is the least internationalized among the property market sector. That is understandable because development is the most risky of the property market, and it involves interacting with planning offices, it involves interacting with local landowners, it also involves interacting with a lot of local institutions, which at times becomes quite challenging in many countries. So how development or developers are internationalizing? Where are they internationalizing? What are the challenges that they face? Will be discussed in lecture on 22nd of May. Then we'll talk about 29th, about the Middle East property market. Is another interesting market where many a time logic doesn't work. Why somebody is developing, well, it's a very different call there. What they are investing in is again a very different call. So we need to understand it's an important market, huge amount of capital flows in there. So let's try and see the dimensions which affect Middle Eastern property market. And finally, on the same day, 29th, we'll close this subject with a discussion on to what extent, after having gone through the whole material, do you think that the markets have internationalized? And what is the path going forward? Because if markets have converged, they have internationalized, the problem there is diversification will not be there, right? Because if all markets are going to behave exactly in the same way, then why should you invest in France or Germany or somewhere else, right? So it's important for us to understand the extent of internationalization. Some organizational remarks. You're most welcome to send me comments, questions on material as well as anything that you want to discuss on international property. You're most welcome to do that. Lecture material would be on LMS before the lecture, definitely, so that you can either download it. If you want to take notes, you can do that. And please feel free to write to me, right? If you want to discuss any of the content or anything related to property markets and their internationalization. Any questions, guys? Okay, I want to tell you a story, okay? Before we get into the theorization and all those boring stuff, right? It's not boring though, but theory, by the name it sounds boring, right? So we'll do that next time. So let me give you some historical context within which property markets have evolved. Because what history tells us is, number one, what institutions have evolved, and these institutions have then impacted upon what kind of property markets would evolve. Starting with 50s, just after the World War II, there were a number of things that changed in the world. There were few influences that were determining what will happen to the institutions, what will happen to the urban development. The first thing was that a number of new independent nations emerged. Just in Asia and Africa, there were 36 new countries that came up, that emerged. After World War, the Europe was reorganized. There were two clear factions. One was the Soviet Union, the other one was very much like America and its allies, who had a very different economic outlook. While one was more toward socialism, the other one was more driven by the market economy. Having said that, when we'll come to market economy and we'll talk about UK and France, you see that even the market economy in different countries could be very different. But what it said, that the world was emerging into a new set of rules, which obviously would have impact on the way the cities would be developed. After World War, a number of cities were destroyed. There was a clearly reconstruction that was happening at the full force. But again, on ideological ground, the world was divided into two factions, which we commonly refer to as Cold War. One was Soviet Union, the other one was very much like the market economy of the US and its allies. Cities started developing very fast. There was a rapid population growth. There was a huge migration from rural hinterland into the cities. And most cities were witnessing phenomenal growth. There are a number of policies and programs that emerged. The most important of them, which led to significant political as well as economic influence, was the Marshall Plan. This was an assistance plan from the US to the war-affected countries in Europe. So Marshall was the Secretary of State who put together a plan of about $15 billion assistance to countries who were for city as well as infrastructure development who were affected by the war. Now, many of the countries that aligned with this one, they had to reform themselves economically. In the sense, they had to have a free trade agreement with the US. They had to adopt the market economy principles, which were the countries like UK, France, all these aligned with the US under the Marshall Plan. But there was another bloc which was emerging, which is the centralized planning and the Soviet bloc, which had a very different kind of institutions that were developing there. First of all the key resources were centralized. What would be those key resources? Land was centralized. The private ownership of land was abolished. It had significant impact in the way the property markets would operate. Because if you don't have a market for land, the property market doesn't emerge there. The other thing that was happening was the industrialization and technology. Most of these cities started to industrialize very quickly. Technology became quite important. In the UK, when they were redeveloping cities, some of the new movements in town and country planning, such as the Garden City or New Town, they started to emerge. There were new cities that were built. All these planning was done in order to address the urban ills, which was congested, there were lots of slums, and so on. Some institutions emerged because new countries needed new institutions. Now, the interesting part is that many of those countries that got independence from colonization around 1950s, many of them adopted democratic governance structure. Some of them became driven by the autocratic or dictatorship ruled by military junta. So I guess what was happening there was different sets of institutions were emerging across different countries. But by end of 50s, there were some lessons that were emerging out of this experience. One was that there was export of Western and Soviet development theories across different countries, the standards as well as the regulations in order to support some of those development theories. The Western theory was very much market-driven, where the invisible hands of market would lead to production and distribution of commodities, which effectively meant that private sector took a driving seat there. While the Soviet development theory was very much based on we need a system where there is a benevolent government who knows what the society requires and accordingly allocates resources. It's more like a systematic allocation of resources for the benefit of society. The two things are very different. Accordingly, the standards and regulations were also evolving. 60s and 70s was another important phase because post-World War, the economy started to grow very fast, and the population also started to grow very fast. But there were some interesting influences that characterized this period. One was that there was a space race. US and its allies and the Soviet bloc both were engaged in showcasing their technological advancement, and they engaged in space war. A lot of investment went into space war. During this period, there was also a Vietnam War, which lasted decades, had huge economic as well as social cost on participating nations. Again, was a consequence of the Cold War between the US and the USSR. Rural to urban migration continued in principal economic centers. So the cities became more dense, bigger, and so on. The number of policies and programs of that period, large infrastructure projects were developed. And there was also a growth or the development mentality that was being pushed by these nations. Any of these required new institutions. National planning agencies and institutions emerged because they needed to plan cities, they needed to plan economy. There was also development of educational program to support some of these growth agenda. There were some lessons and outcome from this period. One is that it became very clear that centralized plan doesn't produce the expected result. While centralized plan had its own success in the initial phase, it soon became inefficient because the economy became too big to be governed by the government. So it was causing problem. Inefficiency became an important feature there. It was also realized that the large infra projects which were driven by the government, they were unsustainable. In UK, it became clearer after World War. The production, distribution, transmission of electricity was combined as one. The railway was combined as one entity. But they became too big to be managed. Inefficiency was a problem. So there was growing realization that the Western standards and approaches may be inappropriate elsewhere. Vietnam was the clear demonstration of that. If you look at these two periods, 1950s and 1960s and 70s, while you would expect, and it's right to expect, that there was a phenomenal growth in real estate development. As cities were building, there was a huge influx of population, so there were great demand for housing, prices started to rise, there was great demand for commercial real estate like offices and so on and so forth. Right? So cities were building at a very fast pace. But let me ask you one question here. What would you think would happen to the ownership structure? Would these properties largely be owned or investor owned but leased? Most of these properties which were getting developed were largely owner occupied, right? Those other institutions were still to evolve, which will make investment in property much more viable and much more kind of interesting investment opportunity for investors. Let's look at 1980s. Fallback of 1970s was that public sector had become monolithic but inefficient. So there was a realization that that's not the way the economy would continue to grow. And in the US, Reagan, and in the UK, Thatcher government, they started to privatize. Many of the state entities or state-owned enterprises were privatized. Housing in the UK, where was the dominance of public sector as a provider of housing through the schemes like right to buy were privatized, in the sense that people had the right to buy those houses. Cities, the big cities had become too big, which also had its own problems. That started the migration to other cities or secondary cities. So now the secondary cities, they started to grow. The USSR also started to reform itself through glasnost or perestroika, which was very much like bringing in the privatization of industry, state-owned enterprises there as well. There were a number of policies and programs. There was a renewed faith in free markets, trade liberalization, and deregulation. The world started to talk about trade liberalization, and we'll see in our later lecture the role of trade liberalization in economic growth. But there were lots of barriers because there were huge tariffs and huge restrictions to cross-border commodity flows and so on and so forth, which had to be dismantled before you could liberalize the trade. Many of the countries which had run the large infrastructure programs funded by budgetary policies, they were running in huge debt and required structural adjustments. A number of institutions emerged. One was the government started to play a smaller role, more like a facilitator, and there was more encouragement for private sector to take on that role. New enterprise zones were set up in the UK. The idea there was to provide facilities so that private sector could competitively produce goods. There was also beginning of empowerment of the third tier of government, which is the local government, so that they could take decision about cities. Some of the lessons and outcomes of this period were that social problems arose due to structural adjustment. When you start to cure the inefficiency by privatizing, there will obviously be job losses. The coal mines suffered quite a lot in the UK, which means many people lost their jobs, which then had its own social implications. There was also a lesson that enlightened leadership can make a difference. They can make a difference to the city. Now, one thing which becomes interesting here is that when some of these new models start to emerge, you would also find new model for property ownership would also start to emerge, which basically means that a large chunk of property that was owner occupied, there was unlocking of wealth that owners started to, because there were plenty of other opportunities to get better returns. So many of those owners started to sell their properties to investor and lease it back for their usage. So there is new lease market started to emerge. What happened in 90s? There were a number of influences of that period. Globalization became a buzzword. Economies started to globalize. The tariff was under discussion. The trade barriers were softened, if not removed. There was end of Soviet Union. Soviet Union fragmented into a number of smaller countries. Another challenge that emerged was the climate change that came to the forefront of agenda, and the technology. Technology has had significant impact on the way one can invest in property or way one can use space. The number of policies and programs, private capital flows and market preferences, they started to shape policy decisions. There are examples like Soros, who, like in the earlier discussion of the European Monetary Union, UK was part of European Monetary Union. But because of exchange rate crisis, UK had to withdraw out of European Monetary Union. So it never became part of euro as a single currency, or never had a common monetary policy as the rest of the European Monetary Union. And a large chunk of that was driven by the currency sales by Soros. The urban programs, they started to become much more market-oriented, sustainable, decentralized, transparent, and accountable. So the urban programs were not driven by center, but rather they became much more responsive to the local requirements. The institution that emerged was the strong local governance. The local governments started to compete with each other. Instead of countries, people started to talk about London, New York, Tokyo, and so on. So the cities took precedence. The rule of law gained momentum to protect individual and their property rights, markets and businesses. This is important because strong property rights is necessary for investment. There are a number of lessons of that period. One is that the local capital market started to play a very important role as it provides long-term investment needs. Soviet Union was suffering for initial phase after decentralization and shift towards democratic governance, required aid. 2000 onwards, there have been a number of new development which have started to affect property markets as well. These influences are the increased terrorism, natural disaster, and other transnational threats, which definitely have a significant impact on property markets as well. Now, internet, which allows 24/7 access, has changed the meaning of the way the space can be used or the way the production can happen. So the production got split into a number of different components. The components which was not necessary got shifted into another zone, time zone. The one which required connection with the clients got shifted in another, and so on and so forth. So there were lots of changes that internet brought to the whole production process. Economies started to grow and the global trade surged. With globalization, the number of cities which are global gateways, they increased. China became one of the prominent countries, with Beijing and Shanghai becoming an important markets. But in 2000, there was also a global financial crisis, which had again a significant impact on economic growth as well as the changing economic order across different countries. There are a number of policies and programs of that period. There was a priority for urban program. The cities were quite important. They were seen as economic gateways, and substantial investment went in cities. Local governments provided enabling frameworks to attract investors and high caliber workers. Institutions were decentralized, more power to the third tier governments. The government resources shifted from development to security, given the heightened security concerns. The private and local investment became key to the development. So what were the lessons? One was the local government. They became incubators for political leadership. So as we would discuss in many cases, particularly in Sweden, the local mayor went on to become the premier of that country. So that became quite important. The transitional countries became part of the world order. These transitional countries were also challenging. While they were growing, there was an investment interest, but given that they have had history of no property rights, because all the property rights were centralized, to create a property market became an interesting challenge. And we'll discuss some of these things, how they created property markets. Cities, they started to master the growth management. The implication of all this was that from owner-occupied property markets to investor-driven property markets, there was a far more development of property markets and property investment vehicles during 2000 and 2010. After that, there are a number of influences that are affecting economies as well as property market. Technology is the biggest disruptor. Big data is another one. It allows us to understand the markets much better. And there is a rise of space as a service. Now, space is being looked at a service. Like, it's not just the square foot that matters. What is in the space also matters. Internet connectivity, the proximity, the cafes, and so on and so forth. They have started to take much more larger space in the discussion between a landlord and the tenant. Cybersecurity is another one that is influencing. The changing business model due to the move towards service. A number of new models have emerged. The physical security of building occupants is a significant challenge, which is affecting the way space is supplied. There are a number of disruptive forces at work. Some of the examples are, there are new entrants in property development. Google, for example. Google is not a developer, right? But they are developing, they are planning to build a new city, which is like from the internet up. Highly tech, highly connected, no geographical boundaries, which is very different. Way of conceptualization of development. Facebook, again, not a developer, but they plan to create mixed-use campus towns. There are new partnerships emerging. Moda Living. Moda Living is a developer which develops build-to-rent and co-share kind of model. Now again, these two, as you would learn in another subject, some of those who are doing property markets and valuation, or you would have done property markets and valuation, there's a one guest speaker who talks about build-to-rent. Now the model is interesting because what it does, it deprivatizes some of the space which can be shared. Airbnb is another one. We all know how it has disrupted the hotel industry. There are new business models coming in. Amazon is looking at more like a different delivery system. WeWork did not work, but that was an interesting model because what it did was, conceptually it was a very strong model in the sense that it allowed small and medium enterprises who cannot own or occupy the full building or larger space can take a smaller space on a much shorter leases, right, in a much flexible ways. And WeWork, what they did, they reorganized the space in much more denser space. So the rent per desk, while was lower for these entities, these enterprises, but overall the total rent that WeWork would get because of densifying the space was much larger than what they would get in a standard normal building. There was also another interesting feature. While WeWork used to lease spaces for a longer lease basis, but they were leasing the space out on a shorter leases. So there was some risk associated with the model. But having said that, this again revolutionized the way space can be used by the companies. So these are some of the forces within which property markets operate. These are some of the challenges which emerge as property markets have evolved over a period of time. But now let's add another dimension to that, which is globalization. Let's define globalization first in a very simple way. So globalization is the worldwide movement towards economic, financial, trade, and communication integration. How the economies, they integrate with each other. The finances or the capital flows, they can move across different countries without any restriction. The trade of commodities and services, how they can integrate, and how communication can happen. The other definition of globalization would be the opening of local and nationalistic perspective to a broader outlook of an interconnected and interdependent world with free transfer of capital, goods, and services across national frontiers. How can the world or the countries get interconnected and interdependent so that the capital, which is the flow of money, goods, and services, transfer across different national frontiers? Now, the globalization at the moment when we talk about, we don't include the movement of labor because that hasn't globalized, and that will probably be most difficult thing to globalize. So unhindered movement of labor is not included. And when we talk about international property market, what are the issues that emerge? First issue is that property as an international phenomenon. Property is not a local asset anymore. It's an international asset. So what does that mean? Transactions versus transacting. There's a transaction cost in any transaction. And there is a transacting cost, or the process of transaction, that also involves cost. And when we are dealing across borders, these two become important and they differ quite a lot from one geography to another geography. To give you an example, a simple stamp duty. Do you know how much is the stamp duty on property in Melbourne? 5%. Yep. In Hong Kong? 0. Yep. In France? 14%. So just think about it. Like, if you are looking at different geographies, the stamp duty, one entity of this transaction cost, is so significantly different. Now take transacting costs. Now suppose you have to buy a property, let's say in Germany. What would you need? You can't just say that, okay, in Berlin, Square A, buy that building. It's not possible, right? You need information. What would you do? You would hire a consultant who would do the due diligence, prepare a report for you, suggest some option. You will bid, may not win the bid, right? So there's a cost that is incurred. So that's a transacting cost, which can be huge in property, particularly when you are looking at international. So understanding what are the transaction and transacting cost. Appraising value of property. could be challenging. The way property is measured in different countries is different, right? So when we measure property here and when we quote, of course it will depend on whether you are measuring office building or whether you are measuring retail. You look at the internal usable space, right? In some countries, they include common areas in that. If somebody is quoting you a price, dollar per square meter, it doesn't tell you what you will get in that per square meter. Is it the internal usable space that you are getting? Or is it inclusive of the common areas, right? Different countries have different ways in which properties are measured, in which properties are valued. There are different, slight differences there as well. Though many countries, they use international IVSC system, international valuation system, but there are other countries, there are local valuation practices which could differ quite a lot. So let's define what are institutions, because a lot of play in this subject is about institution and why we need institution. So in a world of uncertainty, institutions have been used by human beings as an attempt to structure human interaction. What are these human interaction in property? Say, during the transaction, buying and selling. How a buyer or seller should behave in a market. What laws should govern them. They become an institution. These are the rules of game of a society. How property rights that are transacted are protected depends on the laws that surround them. If you buy a property and somebody forcibly takes it away, and if you go to court and it takes 20 years to get that thing sorted, it poses a lot of risk, right? If you're a bank, you lend money. If you can't foreclose a property in the event of default, that poses huge amount of risk. So those laws become important. Those rules become important. So institutions are nothing, but they are the rules of game of a society. They provide the framework of incentives that shape economic, political, and social organization. If there are strong property rights, it provides strong incentives for economic agents to act and produce goods, because they know that their property rights are secure, and they can then work hard and produce more. So what are the institutions? What do they comprise? They comprise formal rules. These are laws, constitution, and the rules, or informal constraint. Now, informal constraints are also very important. These are convention, the code of conduct, norms of behavior. In the UK or in Australia, if you have to operate as a valuer, you need to be a member of RICS or API. You know that, right? These formal institutions. So what these formal institutions are, they are basically code of conduct. They impose code of conduct on their member. So the general public knows that when somebody who is a member of RICS or API, they are working with certain code of conduct, and the valuation report that they will provide will adhere to those standards. But that's not the same in many other countries, right? Anybody can act as a valuer in some countries. That poses a problem there. So these are the informal constraints that society imposes on the behavior. And the third important thing is the effectiveness of their enforcement. You may have rules, you may have laws, but how effective is the enforcement of those laws and rules? if the enforcement is weak, it doesn't help. There are a number of ways in which the formal and informal rules can be enforced. The first one is that they can be enforced through a third-party intervention. The court, they sort it out if there is a dispute. Or they could be through second-party enforcement, in the sense that if one party cheats the other party retaliates. Or there could be first-party imposition, like self-imposed code of conduct. Now, self-imposed code of conduct is very much like RICS members would behave in a particular way. There's a self-imposed code of conduct. Because they would face retaliation, that's a different thing, but it's a self-imposed. So these are a number of different ways in which the rules can be enforced. Now, institutions affect economic performance by determining, together with technology, the transaction and transformation cost. If institutions are efficient, the transaction and transformation cost, transformation is very much like production cost, will be the lowest. If institutions are weak, the transaction and production cost will be quite high. Because you can't believe on anything. You would have to do the due diligence of each and everything. If property rights are weak, you would need to go through huge amount of or huge cost to determine whether what you're buying from someone is secure in terms of titling or not. But if institutions are strong, that cost could be reduced. What is the rationale for institutions? There are two different rationales, efficiency or stability. Or it could be both, efficiency and stability. That is, that institutions provide efficiency to the market actions, and they also provide stability to the market. Institutions, they differ from country to country. There are significant difference. Like, for example, even countries which have a similar kind of law, like England, Hong Kong, and British Columbia, they are all based on English law, but the resultant institutions are different. Like Hong Kong has a land lease system. UK has largely private property ownership. The planning systems are very different. So it's not necessary that the institutions that emerge within the similar legal system would be similar. They could be very different. And we need to understand that. What are transaction cost and what is transacting cost? Now, transaction cost is something which is known upfront. Like these are the costs related to searching and collecting information, the kind of fees that you pay to, say, real estate service providers and so on. These are the bargaining, drafting, and negotiating agreement cost, insurance cost. So these are some of the cost which is known. That is called the transaction cost, which is certain that you would have to pay in any transaction. But what is interesting and what is hidden is a transacting cost. This is the cost incurred in the process of transaction. There's both monetary as well as time cost. And this could vary across different countries quite significantly. So then, in the case of international real estate markets, what are the key issues? What constitutes an international real estate market? Each country has its own property market, which operates within its own institution. So when we talk about international, is it a collection of these countries? Or is it a unified international property market? Or is it an international system of market, in the sense that there is an international use market, there's an international investment market, or international development market? Where do we find information about? We need to look at the cross-border real estate activity, defined by use, investment, and development, as well as cross-border capital flows. What are some of the transmission mechanisms through which internationalization happens? One you observe when you look at data, and substitution or switching between the market. If you look at the capital flows, in 2017, the largest recipient of international capital was the London property market. In 2018, it's Paris. The difference is Brexit, right? A lot of investors, they pulled out their investment and invested in another market. That's the substitution or switching of market depending on the risk and how they change over a period of time. But what it does is that when capital flows from one market to another market, it also takes the knowledge of one market into another market. Leads to maturity and also standardization. Like if, say for example, there's one company which has a headquarter in a certain country. If they move their headquarter, they would want a very similar space in another country. So the standardization in the way the space is developed does happen. The other transmission mechanism is flow of funds. Investors have particular style or particular type of property in mind when they invest. And that also leads to standardization. Flow of information and experience through international service providers. When they move, they internationalize. That also leads to convergence or internationalization. So these are some of the transmission mechanisms through which you observe internationalization to take place. The question then is that how do you define international submarket? Would you say a European market or Asian market, or would you say high risk markets, medium risk or low risk market, or the transparent market, opaque market, or less transparent market? How do you define? Some of these are the challenges which we face when we talk about property market. Because we cannot talk about each and every country. We have to have a functional grouping, a functional way in which we can group these to discuss the markets. So where do we find evidence for an international real estate market? One will find in correlation of market performance. By market performance, we mean how the rental cycles across different countries are, how the investment cycle, how the returns getting correlated. If they are correlated, which means that they are becoming much more aligned with each other, right? Then there are footloose market actors and their action, because these footloose market actors are those, if one market is not giving them their required risk-adjusted return, they would move their capital to another market. So that also provides us with the evidence of an international real estate market, how the capital is moving across different countries. There are limits to internationalization. First is lack of information. As I said to you, the information in property market is difficult, and that causes significant limits to which markets can internationalize. There are risk and uncertainty. The institutions operate in a very different way, and they pose risk. And that, again, given that if you don't understand a market, you would not like to invest in there. There's a risk there. that again limits internationalization. Even though there is a globalization in trade and capital flows, but there are still limits to which the finance, trade, businesses, and professions can move cross-border. That again limits internationalization. The attitudes and perceptions, they also have significant barriers for internationalization. The practices and culture, other dimensions which are important when we consider internationalization, and they pose significant limits. Because of which, what happens is that when you look at an investor's investment portfolio, there was significant home bias, in the sense that their portfolio would be significantly biased towards home asset because they understand that much better than an international market. This still is a question which we'll discuss towards the end of this subject. Whether real estate market, we can call them as international or a global real estate market. The difference between the two is that international would mean that the activities related to use, investment, and development are becoming internationalized. Global would mean a truly unified global system of property market. So where do we see the market today is? That will leave the question towards the end of our subject. How do you categorize property markets? There are a number of different ways. One is that you can classify market with similar rental cycle. The markets which are on a peak or a trough on a rental cycle, you can say you can group them as one. Or you can look at, from the economic point of view, the high growth economies or middle growth economies or low growth economies and so on. And then you say that, like, look, I'm going to classify property markets based on the economic groupings of these countries. Or you can look at the stability or volatility of the markets. Whether the markets are stable, which means that there are not much fluctuations, or if the market is volatile, which means that there are quite significant fluctuations in the market. You can say that these are the one grouping, stable markets, other one could be volatile. Or you could categorize markets by structure. Structure would be real estate types, like, for example, office, retail, industrial, and so on, or real estate quality, the grade A properties, or grade B properties, and so on, or the kind of economic activities that they support. Like, these are markets which are largely service-oriented, office market, which will be London, France, and so on. Or should we be looking at industrial properties, which is Netherlands, and so on. Or by institutions or institutional characteristic. The legal, economic, social, and political institutions. Similar legal, economic, social, political institution could be grouped as one. Like, these are highly transparent markets, or these are opaque markets. Or you could define them by real estate market institutions or market maturity. In this subject, we tend to classify market by the institutions. And when we discuss in the institutional terms. While I won't say that this is the only way of doing it, one could also discuss the market based on the property characteristic and property performance, which again could make a meaningful discussion. But just to structure the discussion for this subject, we'll be using institutions as a governing framework for grouping the markets. Real estate is an important asset class, we all know that. As I said to you, for an investor, it doesn't matter whether they are investing in real estate or any other asset class. They are looking at best risk-adjusted return. Now let's try and look at the size of the market. That will give us a picture of where the opportunities are and where the investments are. So I'm going to use MSCI data on market size. So MSCI, in their methodology, they aggregate real estate assets that meet the following condition. One is that those assets should be held as investment for the purposes of delivering mix of income and capital return. So the assets which are in owner occupied, they are not considered in this in calculating the size of the market. Only those which are held by investor for investment purposes are the ones which are included in this market size calculation. The other important requirement is that these assets should be professionally managed. And the third requirement is that they should be structured as investment interest within portfolios. So based on which, the largest market is the US, where the asset size is somewhere close to 3 trillion. And the next significant market is the UK market, followed by Japan and Germany. China has also emerged as quite a significant market. And this is the investment market, in the sense that these are the properties, these are the properties which are held by investor. The total size of this market is about $8 trillion, which is quite sizable. And how the market has changed over a period of time, at least between 2018 and 2017. So the US is the largest, around $3 trillion, followed by Japan, 831 billion, UK 713. But you can look at some of these other markets which are becoming quite significant and important. Like for example, China is now a larger market than Germany and France. Few years back, the size of Germany and France was much larger than China. Now, one caveat which I would like to say here is that this is investment market. This is not the value of total asset of a country, right? It doesn't include ownership, properties which are in owner occupation, right? So what it also means is some of these countries which are here, some of the emerging markets which are in this, once their ownership properties are converted into investor properties, they also would become, the growth in investment volume there would be far larger. How the investment has changed from 2017, the largest change has been in the US. After the global financial crisis, there was a weak interest in the US market, which has revived significantly. And the size of that market increased by almost like 1.7 trillion. Japan, despite the economy has been sluggish for more than 2 decades now, there's been a renewed growth in the assets there. China, you can see here very clearly that 57.6 billion dollar worth of change, increased investment has happened in China. UK, you can see here there's a negative, which basically means is that after the Brexit or the process of Brexit, there have been withdrawal of capital out of UK market to other markets. There's a clear correlation between the size of the market, size of the property market, and the GDP of an economy. So in this particular chart, what we have on the horizontal axis is the GDP per capita. On the vertical axis, we have the size of the market. And what you can see here is that the markets where the per capita GDP is higher, like for example Singapore or Switzerland, you see a much larger investment that happens in those countries. So in a way, the countries which are high on economic growth and which are transparent witness much larger capital inflows and investment. Who is investing? Who is buying the world? So here we are only looking at the cross-border investment. We are not looking at the assets which are bought by resident of a country. So when we look at international, where is the fund coming from in international context? It gives a very interesting picture. The top 10 cross-border purchasers are these countries. The US is the largest buyer of real estate asset around the world, followed by Germany and Singapore. Now, having said that, the pattern of their investment is very different. It's not that these investors would behave exactly in the same way. The investors in the US would have a very different destination for their capital than Germans. Right? So that's an important distinction to make here, that the behavior is not similar. And why the behavior is not similar will be a topic of discussion in our subsequent lectures. Which are the countries, which are the cities where the capital is being invested? Paris has become the largest, but look at London. In 2018, it was one of the most important destination for real estate investors, cross-border real estate investors. But in 2018, it has significantly reduced, and rather Paris has become an important destination. There are a number of risks that have emerged and that will have impact on property investment. The first is the environmental risk. Cities which are prone to flooding will witness less or negative growth in real estate investment. There is no continent which has remained isolated from geopolitical risk. And that again poses significant challenge for cross-border flows in properties. Technology-driven disruption, as I discussed earlier, is again challenging the way the property is used and will have an impact on investment in property. Most of the markets are maturing and becoming transparent. So real estate investing in the age of transparency would take a very different route. A number of new vehicles for investments are emerging. Does it mean that markets will become much more convergent is a question. But it looks like the way the property would be invested in would be very different. There's endurance of cycles. The cycles have become longer. The recession has become deeper. And that again changes the way the property markets are invested in. So there are a number of questions that also set scope for this subject. The first is the international environment of property market practice, how it has changed, what are the key dimensions to that. The second is the extent to which the real estate market can currently be described as internationalized. To what extent has it internationalized? What were the processes through which markets internationalized so far? And what would be those processes that will lead to internationalization of property markets in the future? In order to understand, there are 4 pillars that this subject will focus on. First, we'll look at the trends, activity, and observe the data. We'll use theory to put a frame within which some of these trends could be analyzed. Then we'll look at sectoral impact of internationalization. By sectoral, I mean for the occupation property, investment, and development property. In addition, we'll also look at real estate service provision. And we'll talk about the institutions and their evolution. So that will broadly provide you with the context of this subject. These are some of the references that I've used today. Happy to take any questions, either on the scope or the way the subject would run going forward. If not, then we'll meet in the tutorial. We have a tutorial today where we'll try and discuss some of those trends related to capital flows. There is a report which is on LMS. You can read. It's a small report, as well as there are a few questions that we'll talk about. But there is a brief talk on built in. Sorry? 1 minute. It takes 1 minute. Okay. On built industry group. So would you like to come in? Yeah, just take my slides out.
This one here?
Yeah. This one. Use this one, I think that's good for recording.
Okay, hello everyone. Is everyone here aware of the Built Industry Group? I feel everyone should be. Anyway, because we're a student group run through the MSD, and our objective as a team is to try to get students involved with industry. And so we, coming up, have our Open Day series, which is our biggest event of the year, which involves us getting you guys to go out into various property firms or planning firms, architecture firms. So the objective is to get an idea of what it's like to work in these sort of industries and get hands-on experience, and also have like a bit of opportunity to network and discuss with actual working professionals right now. So, for example, we have 5 firms here. 3 of them are property related and 2 of them are planning. But then again, we do cover architecture, construction as well. So the ones we have Kapaya, which is a planning firm, Chudkett Kramer, property evaluation and advisory service, M3 Property, now a property evaluation company, Mirvac, property developers, and the Victorian Planning Authority. So across these 5 different firms, we have different activities proposed. So for Mirvac, there is a site visit to their new older fleet development. And so this Open Day actually gets you to go to the site, have a look at this development, see the stages they're at, the processes that go on, and it gives opportunity to talk to them as well. So the Victorian Planning Authority, even though it's not strictly property related, we do cover a lot of planning in property. So this is a good activity to show you how they introduce the planning assessments and look at mapping details. And then Kapaya it's an engagement workshop. This one again is planning related. And then for Chudkett Kramer and M3 Property, it's going through like a presentation of the company itself, the business areas they cover, as well as a Q&A session and a chance to talk to the professionals there, get a bit of networking as well. Spots are limited, that's the thing, because you're going to accommodate so many students. So I do encourage everyone to sign up. If you're a member with us, it's free to come. So please, if you can, just follow the bit link there, and that will lead to registration. We also go on our website, Built Industry Group /Open Day, and they'll come up and tell you what each firm and activities doing, more detailed than what I just said. Yeah, it's pretty much it from me. Thank you. Yeah. Please come.
Thank you very much. So